Hey, what's up? My name is Sage. I'm the lead trader here at Nexural Trading, and in this video, I'm going to be breaking down one of the indicators that I built for you guys. It's called the Qpulse indicator. Now, with all the things that I build, they're all absolutely free, so you can use them to your heart's content. And with me, I'm very transparent on the good, the bad, and just how things are built overall. I don't believe that indicators should cost anything, right? I build them, I use them myself, and I really do like sharing with my community. If you are so interested after watching this video or any other video that I make, joining the Discord, I don't charge for that at all, right? I trade on a daily basis, and if you want to join in and learn more about trading, then please feel free to do so, okay? So let me jump into the profile here. This is my profile here on TradingView, Nexural Trading. The link will be in the description. And the indicator that I'm going to be talking about today specifically is 3 rows from the top all the way to the right-hand side. It's called the Qpulse indicator. Now, with my videos, I have a tendency of explaining quite in depth and giving you a lot of information and just a lot of examples. I do believe that us traders, the way that we learn, we're visual people, and we need to learn after doing things 100 or 1,000 times. I know for me particularly, I need to go over something and just make it muscle memory over a long period of time. And I also need to be convinced, yeah, this is working because of X, Y, Z. That's exactly what I'm going to be doing in this video. I don't like to sugarcoat. If you know me, if you've been trading with me for a number of years, you know exactly how I am. So let's jump into this. I'm going to clean my chart here real quick, and then we'll explain exactly how the indicator works. So first and foremost, right, we're going to be looking at NQ. It is impossible for me to go over every market, over every situation, over every piece of price action that would amplify exactly where this does well and where it doesn't. So we're going to stick to this, okay? The markets that I generally trade are going to be futures markets, and that is a plethora of different just tickers overall. So I have the full market context that I like to follow along. If you want to take a screenshot of this, that's perfectly fine. So this is going to be good for crude oil. It's going to be good for gold. It's going to be good for silver, for ETH, for a number of different things. Later on in the video, I will talk about the settings. I don't want this video to be a math-based video. I really don't think that talking about math and talking about how something is built and looking over the code is necessarily going to be conducive or even beneficial for us to be practical traders. Trading is a practical endeavor. If you are practically good at this, you don't necessarily have to be the smartest person in the room. You just have to have really good emotional intelligence and a really good system that you follow suit with. So even with the indicators that I build, no matter how good they are or how not good they are, or how much money you spend on an indicator, which I've done over the years, I've spent thousands of dollars on indicators. It doesn't really matter if you don't understand the tool inside and out. You really need to understand the tool well, so you understand not only its implications, but if it's going to be congruous or incongruous with other pieces of data that you're also plotting on your chart. You're going to know exactly what I mean here when I show you my particular chart. So here we are. This is NQ. Generally, this is going to be really good for the indexes. It's going to be quite responsive, and it's sort of funky looking, right? I'm not going to pretend it's not. It's a funky looking indicator. At its core, it's going to be an RSI-based indicator that will give you a fair degree of accuracy on the turns as opposed to a traditional RSI indicator that is just a silly little line. I don't really like silly lines when it comes to trading in general because institutions, quant traders, if you're a little bit more advanced on this, I'm not going to go into the advanced stuff, but if you're a little bit more advanced, we don't generally like looking at lines. We like looking at imbalances, and we like looking at tables and data that tells us, hey, this is where the imbalance is, this is the statistical significance, and this is why we're making decisions X, Y, Z. So in that sense, I am very much a probabilistic trader because I look at those imbalances. The stronger the imbalance, usually the stronger the signal. And that's why you're looking at what you see here. Out the gate, you're looking at basically green and red bars, right? Those are going to be columns, and the significance of their height is substantial. It really is quite substantial. Let me explain it from a visual perspective first, and then we'll get into how to actually use it. So remember, I started off with this. For the markets that I like to trade, is this going to work on equities? Yes, it will work on equities, but you need to tune it. Tuning is something that retail traders and just traders in general don't talk about. Each indicator and each market needs to have a tool that is finely tuned for that particular market because they're all different, right? Walmart doesn't trade the same as NVIDIA. AMD doesn't trade the same as XYZ. They're all different. So with these tools specifically engineered for futures market, just keep that in mind, okay? Let's start off with this. There's a lot going on here visually. So these bands that you're seeing, this red coloration and this hue, this is ATR calculation. And this is going to be ATR calculation here as well. So the red hue and the green hue, not really overall significant, but the bands actually are. So when the bands are contracting, that ATR is contracting. When the bands are expanding, that means that volatility is relatively high. So when you have a sell-off, when you start seeing that it kind of looks like volatility is picking up, you'll notice that the bands start expanding. And when you start picking up like this, sometimes with breakouts or sometimes with moves higher, you also have a volatility spike. So this is not actually wrong on the calculation. Very often, if you're using something ATR based or you're using like raw calculations for volatility, you will see on a breakout volatility also expand. So that's why you see that here. Now, another thing, let's just remove the crude drawings that I have. You have something called a heat map. This heat map is just an additional layer. It's just going to tell you, hey, fish on or fish off. I like to fish, so I use a lot of fishing analogies in my trading. What this is going to tell you is if I'm holding on to a long position, green should signify long and red should signify short for you guys. If you see something like this where the heat map is basically a very strong hue, either red or green, or you guys can change this in the settings as well, probably want to hold on to that position. Where I think this indicator actually does really, really well is where it tells you not to trade. So here's an important concept. I'm going to do a close-up on my face here. This is really, really important. Trading is not just about when to take a trade, but it's also about trade management. When to take a trade is actually easy. You can take a trade whenever you want. But it's about reading the signal and reading the room and building the context on whether you should take a long or a short. This indicator, in my opinion, I know that I built it and I know that I'm biased, but I use this extensively. And so do a lot of the traders that are trading with me on a daily basis. When we're using this, it builds the context pretty well. It tells us, hey, not a lot of activity here. Probably don't want to be taking the trade. So if you're already a pretty good trader, or if you're here, maybe you're looking at my face for the first time and you're thinking, well, is this indicator going to make me rich? Is this really going to do the thing for me? It depends. It depends on how good you are at interpreting the data. That's ultimately what it is. So looking back, let's just look at the indicator again. Looking at this, where do you think the strongest signals are, right? To your eye, hopefully I'm explaining this and educating you on this correctly. To your eye, it's where we break above the bands. Wherever you see the columns that are breaking above the bands, usually stronger signals. And you're going to see that here in a second. Where you see, kind of looks like the height of those columns are quite high. Well, we might have a fairly strong signal, fairly strong long or fairly strong short. So let's minimize this for just a second. And let's see if this lines up. This was a fairly good long. What about here? Fairly good short. Did we line up? It kind of looks like we did, right? Where are we? To my eye, it looks like we were maybe a candle late. Okay, I don't know. If you've been doing this long enough, you know that being a candle late is perfectly acceptable. What about here, right? We had a footprint candle right there, and then we had one burst above the cloud right here. So would we have taken the signal? Maybe, maybe not. I generally like to look at when we break above the ATR band, and then I go from there. And then it's all about risk management from that perspective, okay? What about here? We got a short signal. We actually got it on this candle. Does that look like it lined up quite well? Yeah, it kind of looks like it lined up quite well. But Sage, I see the short coming in from here. With the system that I use, I would have pinpoint accurate got that short signal. Cool. That's cool. I'm not trying to compete with other systems. I'm not necessarily here to tell you, hey, this system is going to be much better than any other system. That's not what these videos are about, and it's not what these indicators are about. This is so you can learn how to read price action and what the candles are not telling you. Because when you're looking at a candle, you're just looking at height information and you're looking at those elongated candles, top, bottom, high, and low. That's it. With something like this, it gives you volume and also ATR-based information. Why would that be important? Instead of having 13 indicators on your chart, you just have one that tells you, hey, is there a lot of something and is there imbalance there? That's ultimately what this does, and it does so quite well, actually. So let's go back to this. What is this telling me, and how do I read this damn thing? When I'm starting to oscillate from one direction to the other, I want to pay attention on when we are crossing the zero line. The zero line is going to be this white line right here. Right? So it's pretty self-explanatory. Whenever we see in context off of, let's say, the 15-minute time frame, doesn't matter what time frame, but the 15-minute time frame is what I started off with. When I start noticing, or if I have a very strong bias as a novice trader, if you are a novice trader, I got to stop the video here for just a second and really, really look at you and tell you this. I've been doing this a long time. close to 15 years now. I've been trading since 2010. If you are a person that comes into the market with a very heavy bias on the scalping side, that generally is not going to be to your benefit, because that is what market makers are paying attention to. They're really, really focused and dialed in on your psychology, on you having a preemptive notion or a decision that ultimately is going to propagate you making bad decisions. You don't want to be making decisions based off feeling. You definitely don't want to do that. You want to do it based on what you're actually seeing real time. There's something to be said here, and it's worth me spending 2 seconds in explaining this. When you're jumping into the chart, when you're jumping into whatever trading situation, it's not necessarily about you candle reading or you having that bias and then being struck on that. It's about you being adaptive enough and reading what's going on real time. So this is something that I have a huge problem with, huge. And this is why I build the things that I build, to actually solve this problem. When we're looking at, I'm going to jump into the chart. When we're looking at context, especially when you're going out further in time, I know a lot of us build context off the 1 hour time frame. The further back in time you go, the less significant that overall level is. I know some of us are going to be like, no. But yes. So hear me out. When you see a support or resistance level, are these important? Yes, they are important. I'm not going to say that they're not, but they are less important the further back you go. Why? Because at that point in time, something was happening that would ultimately move that price action in one direction or the other. Does it necessarily mean that it will matter for the time period that we're in? No, not really. What will matter is what's happening on the tape, level 2, order flow, data, real time. That's what matters. That's really, really what matters. So sometimes people are looking at charts and they're like, hey, this NVIDIA had support all the way back to 68, and it's definitely not going to be breaking 68 because whatever the case may be. You have to understand this. You really, really have to understand this. Historical price action isn't going to be indicative of what's going to happen in the future. The only thing that's going to indicate that is what's actually hitting the tape. So you have historical reference and you have what's going on real time. When you marry the two things, then you start to become a well-rounded and a mature trader. So when you're looking back, I'm not going to say that you can't look back 3-4 weeks. I'm not saying that at all. Right? Some of us are going to be like, well, it's Sage, I do that all the time. I do that as well, but I don't go back that far. What I'm doing is I'm using calculations and real-time data via different indicators. I personally like to use a volume profile. The volume profile will tell me historically where that accumulation and distribution was and where the largest orders were exchanged, where that auction happened. There also is something called, I would love to introduce this because a lot of people don't know about this, but an order flow profile. The order flow profile is going to look exactly like a volume profile, but it's going to be for orders that are sitting on the tape. We can't get that in TradingView. Unfortunately, I would love to build that in Trading, but you just can't do it because we don't have order flow data. But I digress, right? I'm running off on a tangent. When you're looking at just overall, if you want to take a directional trade, don't be overly biased. Don't be overly biased because it will shoot you in the foot more times than it actually helps you out. And I'm going to prove this to you in just a couple examples. Off the 15-minute time frame using the indicator, I know that most of us are going to come into a trading session with an unbelievable bias. I see it all the time, literally all the time. So here, if I'm going into, let's say the trading day, the last trading day, where most people were thinking, well, jobs report were terrible, and now I'm going to be taking a short position, yada, 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 yada. What does the Pulse indicator do quite well? This is an incredible segue into believing the calculations that are actually happening on something that you know, that you've engineered, and that you actually trust, because they're lining up on the changes of direction. Let me prove that to you. If I'm going to look at this, right, the bias usually for anyone, I mean, even for me, I was like, all right, we're probably going to be trading lower. But I'm paying attention to this indicator and a couple of other ones that I like to use just so I can make sure who's in control, buyers or sellers. So we were definitely sellers in control here. There's no question about it, right? We were sellers in control for the majority of this time. This is a couple hours, right? We're talking about, I think this happened 3 o'clock in the morning. No doubt about it. But when market opened, what I noticed off the Pulse indicator is that pulse or that imbalance or that, let's call it the selling pressure, right? Let's just make it real simple. The selling pressure was no longer there. It's just not there. So what am I going to do? Am I going to chase that short position after we just moved 300 points, 400 points off of that top? I probably don't want to do that. This is where this indicator shines, in my personal opinion. Again, I've said this already. I know I'm biased. I'm very biased. But this is where the indicator shines and keeps me from making silly decisions. Instead of me taking 7 losing trades, I'll probably take 3, and then I go from there. And then I'm on to the next trade that makes me 40, 50, 60, 100 points. This is going to tell me, hey, probably don't want to be chasing shorts because fish is not on. If you guys, right, if you fish, you can feel the weight of the fish pulling or tugging, and this is what that does. This is telling me, hey, I don't really necessarily see the pressure. The price action that's happening between this candle and this candle doesn't really look like there's a lot of activity. I can pull a volume, I can put a footprint chart here, and you can see there's probably not a lot of exchange of contracts, but I don't need to do that. I think the messaging is pretty clear. These 2 candles, not a lot happening, but we had some activity on this one, and we definitely had some activity here. So what is this telling me? This is telling me that I probably shouldn't be chasing shorts, even though my bias is short. See? Want to be careful with this. Want to be careful if you have too strong a bias long or too strong a bias short. This will tell you, hey, maybe pay attention to this candle and what's actually going on in real time. Is it going to be right every single time when you take a directional trade? No, of course not. But this will help you on mitigating not only what trades not to take, but also your entries when you do take your entry, where to set your stop loss, more or less. The stop loss management methodology, the way that you should think about stop losses, isn't necessarily something that one can teach you. We can tell you, hey, set it on a breakup structure or give it 20 points or 30 points. Those are static calculations. Usually with a more mature system, you have something that is dynamic as opposed to static. I like dynamic calculations. So where to set your stop loss if you're going to take a long or a short position, depending on if you're a structural based trader. I'm going to share with you what that is. If I'm going to take this long off of this candle or even this candle, I'm probably going to be setting my stop loss maybe around there. If you're going to do it based on body of the candle, that's okay. If you're going to do it based on wick because you're looking at 300 points as a move, that's okay as well. I'm generally not going to do that. I'm going to set it, a happy medium. It's going to be a happy medium between point-based system and also where I'm seeing breakup structure. What happens if this starts moving in my direction, right? Because I'm looking at this candle real time and it's actually moving real time. Probably if this starts going in my direction, I'm going to move the stop loss. And if this is telling me that fish is still on, I'm just going to move it accordingly. But what happens, Sage? I know a lot of us are thinking this. What happens if I get wicked out of the position right here? This is just part of life. It's just part of life for you to be wicked out of a trade. It's just part of trading overall. And there's not really much you can do about this as a discretionary trader. There are some things that you can do if you're using quantitative based strategies and if you're using live order flow that's hitting a particular application or a bot that you build. That's totally fine. You can definitely do that. But you can't really mitigate what we call rogue wicks. Those are designed to be there to create liquidity to sweep you out. What the pulse indicator will do, in my opinion, what it will do is it'll tell you, well, we got that wick, but kind of looks like buying pressure is still there. So that's what that will do. All right. This is just one very, very specific example. When I'm educating or when I'm teaching people how to use tools that I built or just tools in general, I like to be really, really specific so you can take that specific example and you can use it in different scenarios. Obviously, there's no price action that is exactly the same. It doesn't exist. But there are patterns and scenarios that you can learn to recognize after you do this for a very long time, okay? So take a pause here, take a break. We've already gotten through a very long part of the video, and then I'm going to start introducing to you the multi-time frame concepts that not only builds context here for what you're trading, but also is going to eliminate some of the trades that you probably shouldn't be taking. We're going to do that here in just a second. Okay, so this chart looks a little bit different than the other charts. It's a multi-time frame charts. You don't need 13 different time frames. You need 2, 3. 3 is honestly, I think, overkill, but 2. The ones that I recommend are going to be the 3-minute and the 15-minute time frame. Mathematically, they are synchronous. And you don't have to use the 3 and 15, right? Everything that I teach you in all the videos that you watch, all the content and the time that you spend with me or any other trader, you have to understand that it's all about building a framework that you yourself can use that is particular, customized to you. You don't need to copy other people's trading systems. That's not what this is about. I made my own trading system, right? Because I don't want to copy other people. I want something that's going to be completely unique to me. But the multi-time frame thing is something that everyone should do, because the multi-time frame will tell you what is important and probably what isn't. The 1 hour time frame for a lot of us. I know very successful traders that 1 hour time frame is everything, literally everything, because it gives you gargantuan moves and it tells you, all right, now we're trading into supply and demand, or now we're trading into some order flow pockets, or this and that, whatever. If you build heat maps and those kinds of things, you know exactly what I'm talking about. I think the 1 hour time frame is a little too broad stroke, right? You're taking a very large brush on something that you're trying to do off of a shorter time frame. Most of you are not me. Most of you are not sitting in front of the computer for 6 hours a day and trying to hit trades. Some of us just want to trade for 15 minutes at market open and then go about our business, because you guys have lives, you have children, you have all this stuff that you got to take care of, businesses, whatever. I think that the 15-minute time frame will be your happy medium. I happen to know this, right? The 15-minute is a golden standard for large institutions, hedge funds, whatever. We want to hang out there. It is an incredibly, incredibly good, stable price action for you to catch gargantuan moves, just like the 1 hour time frame. If you want the 3 time frame sort of deal going on, okay, fine. You have the 1, the 15, and they're all mathematically synchronous as well. But I think that this is a little bit overkill for what I'm trying to teach you. So what does the 15-minute do that the 3-minute or the 1 minute does not do? This is the same trading day, but notice, if you don't know this, notice this. There is so much more noise going on right here, right? There's so many more signals as opposed to what's going on the 15-minute. Does that make sense? So a higher time frame will naturally filter out what might not be as significant or as important. With high frequency trading, I talk about it a lot because it's something that really fascinates me. I don't do high frequency trading because I can't afford those kinds of systems. And honestly, I don't have enough room in my little apartment here for me to house server racks. And I don't want to do that either. But for high frequency trading, it's just capturing those inefficiencies in the market. And that's what trading is all about, is just capturing inefficiencies and exactly where those imbalance points can be. So just check out the 1 minute, dude. How many signals are you going to be taking off the 1 minute time frame? If you're taking, this is just generally my opinion. You don't have to agree with me on this. If you're taking more than 10 trades a day, then you're not making it work, you're not doing something right. You should not be taking over 10 trades and then look at the end of the day and you made 13 bucks. This is not how it is. If there are a lot of trades that I take, I've taken more than 10 trades in a day, sure. But if you can't make it happen in less than 10 trades and you're relatively well balanced and you got something to show for it, then probably you should cut down. It's not about quantity, it's about quality. So you take 3 trades, you make $1,500 on that day, and oh my goodness, there was a great trade that came in after hours and this, that. You have to be able to reconcile that. You have to be able to have the psychological maturity to say, okay, I made my money, I have my 3 good quality trades, and then I go about my day. Cool. That's an important concept here to introduce, especially for the newer traders. But anyway, let's get back to the point. You can use the 1 minute or the 3 minute time frame to take your entry. That's totally fine. What happens, or what generally happens, instead of building supply and demand areas, instead of putting all these lines, the reason why I don't like putting lines on my chart like this, sometimes I do. I'm not going to say that I don't. You'll see them in screenshots of mine. But generally why I don't like doing this is because why are we putting subjective lines here? The rest of the market is not looking at your support and resistance levels, right? We're definitely not seeing that, but the rest of the market can see what's happening via the tape, because millions of systems out there are using tape reading software technology in order to see what's going on via imbalances. That we see. We definitely see that. You want to look at what the majority of the market overall is looking at. If you are looking at maybe using a high quality indicator that actually does look at calculations as opposed to your subjective opinion, that's okay. I think that is more of a dynamic approach. This is a very static approach. I said this already a couple minutes ago. I don't like any static calculations, because how do we know that the market is going to respect that? We don't. Sometimes I will put on a line. I'm like, oh, market respect that. I know what I'm doing. Not really. You just got lucky. That's just my interpretation of it. So what I'm going to do is I'm going to put a volume profile here. The volume profile will tell me, if it's a session volume profile, hey, this is where the support and resistance might be via accumulation on how many shares or contracts were traded at that particular point. I'm not going to put the session volume profile because this video is complicated enough, but I digress. Cool. So I'm not really worried about that. What I am worried about is on the 15-minute time frame, if we're trading into a zone. If you want to use zones, that's okay. There's no problem with that. If we're trading into a zone, how are we going to react off of this right here, off the 15-minute? Am I starting to lose that selling pressure? Am I accumulating that selling pressure? Or now are we starting to move in the other direction? Okay. If we are starting to move in the other direction, I'm looking for my entry on the 3-minute. It really is that simple. So you can use the dual time frame methodology concept. I use it extensively, and I'm also looking at order flow on a different computer that I have off here to the side. I'm looking at all three things at the same time, because as soon as I see that that imbalance is moving long or short, and I see it on the 3-minute and the 15-minute time frame, I'm taking the trade. I'm definitely going to be taking the trade. I'll give you a perfect example of that in just the last 2 to 3 trading sessions. So I'm looking at this, all this selling pressure coming in, right? All this selling pressure. Holy crap, I got this bias here short, but all of a sudden we stop. And I see that on the pulse indicator. It doesn't look like there's a lot of activity. I have the one setup, and then I have the punch line. What am I going to do here? I'm probably going to take this trade. Let's say I take this trade at 7:05. I actually think I did take this at 7:05. I have to look at the Discord and see. But take this at 7:05. I take that long, moves in my direction, move up my stop loss, de-risk. And then this pulse indicator tells me, all right, hold on to it for as long as you need to. So let's see where that goes. The rest of it, after the pulse indicator tells me to get in, then it's just a matter of risk management. But this is only going to tell me to take the long if that short pressure no longer is there. That's it. That really, really is it. So how do I take that and consolidate it with what's going on here on the 3-minute time frame? This just gives me a more microscopic look into actually what's going on some of those candles. That's all it is. That really, really is all it is. So if this is lining up and I'm also getting the signal here, then I'm taking the trade at approximately 7:05 or 7:10. I can't remember exactly when I took this, but taking that with a breakup structure above, because we consolidated here for however long it was, right? 15 minutes, 20 minutes, whatever the case was. Taking the position, setting the stop loss at a breakup structure here lower, because if we start breaking structure here lower, then I'm looking for the setup lower. That's all. That's all. No big deal. And we go from there. What about a short signal? Let's now talk about the most recent short signal. And then I'll go back to the previous day and give you an example there. The most recent short signal, where did that come in? You have some short signals off here on the 3-minute time frame, do you not? And they're lining up quite well. Here it is, right? Notice my grimace. Right, we have some short signals that are lining up pretty accurately, dude. We have one here, we have a short signal here, we have one here, and we definitely have a short signal here, right? This came in, man, it's pretty accurate, right? It looks like the pulse indicator didn't necessarily capture the activity here, so we have something that was not properly calculated. Maybe there wasn't a lot of volatility, maybe there wasn't a lot of volume, but whatever the case is. But now I'm looking at the 15-minute time frame, and notice where I pointed out all those little areas. Where is the most significant short coming in? The most significant short, in my opinion, is when we burst right here. And this is exactly where we started seeing that acceleration here to the downside. Right? A couple traders actually did catch this trade. I didn't. I wasn't on, wasn't paying attention, whatever. But here on the 15-minute, in confluence with what's going on the 3-minute, now I have a better interpretation of what's going on with different time frames. And this is what's cool about this, right? This filters out naturally, hey, maybe I should be taking a trade or maybe I shouldn't be taking a trade. On the shorter time frames, you're always going to get signals. It's just the shorter time frame. There's more activity. And this is like looking at ants or looking at grains of sand using a magnifier. It's going to look huge, right? What's happening on maybe this scale might look this big if you're using the proper magnification. We don't want that. We want to be paying attention to what's going on the 15-minute time frame, because there, as I've stated, in my opinion, this is not any statistical fact. There's nothing concrete. There's no ultimatum to this. But on the 15-minute time frame, it is noise suppression enough, and it's diluted enough where it gives you a happy medium between what you can find off the 1-hour time frame and what you might find off the 5-minute time frame. It's just a really, really nice synchronous number that gives you really good size moves. That's ultimately what it comes down to, okay? So that's the dual time frame. That's how to read the signals overall on the pulse indicator. I'm gonna give you a couple of other examples, then we'll talk about settings. We'll talk a little bit more about psychology and methodology, and then we'll conclude the video from here so you guys can start using the indicator and see exactly if it's gonna be something that will benefit you as a trader or not. Naturally, what you should be asking yourself at this point in time is, okay, I see how it works. Now, where are some of the pitfalls and where will it not work? And I actually like this question if I ever get asked this, which I don't. I don't get asked this often enough. But using more than one indicator, remember this is a core concept of mine, using more than one indicator to compensate the information that one is giving you versus what one is not giving you is, I think, a little bit of the secret sauce when it comes to doing discretionary trading. Am I discretionary trading all the time, end all be all day long? No, I'm going to be honest. That's not what I'm doing. I'm automating a lot of the stuff that we're discussing. But the automation is only going to be as good as the data or the calculations and the code that you're feeding the overall bot or the overall mechanism or system that you have in place. So sometimes people are like, automating is kind of difficult and my bot is not really working and this and that. It really depends on what calculations overall you're seeing. So understanding these concepts and understanding, okay, this is how it's reading, this is what it's doing, this is how it's making decisions overall, and having that hierarchy structure ultimately is going to build you a good bot and make you a good trader overall. Cool. All right. So I just wanted to throw that in there. I'm very much psychologically based when it comes to trading because psychology is everything when it comes to trading. Let's go. Let's talk a little bit more about examples. This is our happy medium. This is the 5-minute time frame, right? I use 3 minutes to overall decide when I'm taking a position, but 5 minute is going to convey this message really clear. This is the last trading session. Where are the signals? The signals are going to be when we're oscillating off of the white line. We're looking at price action. If you are not doing this, then this is not going to work. You build your context. However you build your context, if you're using whatever, if you're using fair value gaps, if you're using supply and demand, if you're using any of these, there's a plethora of them. All of them are basically going to tell you the same thing at the same time. A long is a long, a short is a short. So you're using that. You consolidate in a period of time. You consolidate here, right? If you're using an orb strategy, all right, the first 15-minute candle, we can do that, or the first 5-minute candle, which would have been this one right here. When are we breaking out of that zone? Whatever you want to use. The pulse indicator will say, okay, so we have a breakout here, but kind of was smacked down, and these 3 candles are sort of, they're kind of killing our vibe. But then finally, we have some candles that are here, kind of broke out, and then we have this wicked, a wicked wick. That's literally what it is. This wick right here that created the liquidity, and it did the sweep. And I actually like that I'm using this example because this happens literally all the time. When you're dealing with a situation like this, what will the pulse indicator actually do? What will it tell you? It'll say, hey, you took the position at the first sign of a long, which is exactly what I did, and that just went away. So in this situation, this thing did its job. It really, really did its job quite well. And then on top of that, it gave us the next wick that was saying, all right, now pressure's back on. It literally is like that sometimes. It's never going to be a situation where you're in a trade and you just catch a beautiful 3, 4, 5, 6, 10 candles of just straight green or just straight red. Very rarely does that happen. You're going to see jagged price action, and you're going to see manipulation, and you're going to see a whole bunch of other vocabulary words that you can insert here of where they're just trying to trip you up. That's what trading is about. Remember, you're competing with other people, so there's no such thing as making this easy and buying a winning lottery ticket with you knowing what the numbers are going to be in the future. That's not how this works. This will tell you, hey, calculating things real time as they're happening. Should I be holding on to it? Should I not be holding on to it? In this situation, this is a very clear example on take the long position. I got the signal right here. Maybe I would have been wicked out here. Who knows, right? Maybe I would have been wicked out there, but the selling pressure is still on. You can decide that you want to jump back into the trade, and then you go from there. Same thing here with the shorts. Was there a strong indication of shorts that were coming in? I didn't see it. I don't necessarily see it. I don't see it here either. I do see it here. I definitely see it off of this candle. Boom. Sometimes what will happen is, all right, the signal was back here. There's some systems out there that will be able to accurately depict, hey, maybe you should have taken a short at that body, the top of the body. This system doesn't do that. It doesn't do that at all. It's looking at where we can pivot off from, and it's not going to be accurate to 5, 10 points. I don't think, to be honest, I don't think any system can do that. But it's going to be accurate to where that accumulation is, breaking out of the range, and then seeing some sort of follow through. If there is some follow through to be had, the system will pick up on it. Is it going to pick up on everyone? No, of course not. Of course not. All right, so let's just say I would have taken this signal short right here. I would have personally taken this short right about here. Let's move that line. And then more than likely, I would have been stopped out on this candle. Probably wouldn't have taken a stop loss here. And then this long, I actually did signal this long. I took this long because this candle bursted out, okay? I took it on this particular candle right here, bursted out, and then I got stopped for, I believe it was 20 points. If you're in the Discord, you remember this, depending on when you watch this video. But anyway, digress. Then the same thing here, right? Oscillated here long, probably would have taken a long position because it looks like we had a decent breakout. And this is a perfect example of where it was smacked down. So you went from one direction to the other, and then it was just a very clear short. But what will this do? what will this do? I take the long position right here, or maybe I take it a little bit higher. Take it a little bit higher, move 10 points in my direction, de-risk, and then just take a small loss. Take a 5-10 point loss and move on with my day. Oh, but Sage, I should have taken the short position there. Yeah, should have taken the short. But you wouldn't have known that because this signal came in first. That's how it works. It's not about, it really, I cannot emphasize this enough. It's not about you being right all the time. It's about you taking a position and managing it correctly. So when you're wrong, it's not a big loss. Get it? Take 3-4 small losses and you incur them. It's just part of it. It's just overall part of the, if I'm looking at someone's just trading journal, I'm just looking at their history. Very often I yell at people in my Discord all the time. I'm like, yo, you made some money. You made $7,000. That's awesome. No problem. But your losses are egregious. I mean, you could have made $13,000. See what I'm saying? So with this strategy and this overall way of thinking, yeah, you're going to be taking losing trades all the time, but you'll be able to manage them correctly because this very clearly tells you, hey, this is when the pressure is on, this is when the pressure is off, so on and so forth. Let's do a couple more examples because I love doing examples. I like doing practical examples. The previous day, I actually call this long. The previous day I tried 2 longs. One I was not successful with, and then the other I actually was very successful with. And then there was some people that caught this short. I think I was making coffee or something. Pretty clear. Let's look at the changes of direction. This is something that I wanted to illustrate in these videos. Remember, I can't talk about everything or every situation, but this is an important concept. Concept is those strong changes of direction. If those strong changes of direction are lining up with where the pulse indicator is telling you, hey, pressure on, pressure off, it doesn't have to just be a pulse indicator. It could be any oscillator. Any oscillator that you pick off TradingView, if they're lining up like this, you have a good quality indicator. Are we lining up right here? Yeah, we are. Are we lining up on a strong change of direction here? Yeah, we did. It looks like we absolutely perfectly did. What about here? Was there a strong change of direction? Kind of looks like there was some activity, but we got more of that push right around here. Was this a great quality signal? I wouldn't have taken it because we didn't break above the band, so I wouldn't have done that. What about here? Yeah, maybe I would have taken this. I would have taken this as a low of day break, and then I would have been clapped here with maybe 10 point stop loss. Definitely would have taken a trade like that. What about here? Were we bursting above the cloud? No, we weren't bursting above the cloud. Sometimes I'll take this trade a little bit early. If I have a particular feeling about something, yeah, I'll probably take it early. But where the signal is the strongest is when the first candle is bursting above that cloud. That means that there's some activity and it's happening relatively quickly. Okay, so we definitely had that here with the short. That first little column, that first little bar bursted below that cloud, and then this right here should have been taken a short right about here. This would have been a banger trade if I would have taken it. I don't remember if anyone did. If you guys did take it and you're part of my Discord, just hit me up in the comment section. But next was this. This is a very clear long signal. It really is quite clear. Clear long signal right here on this candle. And then I'm taking that long, and all I have to do is just set the stop loss a little bit lower than where my entry was. It's subjective. We're not going to have a debate on where should we set the stop loss. The risk reward just needs to be there. That's all. If it's 10 points, 12 points, 13 points, we're not going to debate that. We're going to debate on how far away you are from break of structure, and if it's like 80 point stop loss. We don't want to be doing that. So here we got that signal, and we had that follow through. Do you know you're going to be catching a 300 point trade? You'll never know. I hate when people do that. I hate when traders are like, yeah, I caught this 300 point trade and I knew it was going to be 300. No, you didn't. No, you just didn't. That's not how this works. Probabilistic setups, high probability setups. That's it. If anyone is saying anything different, I've been doing this long enough to know that if anyone says anything different than that, then I'm sorry, they're just full of shit. So let's go back here to the chart. Just pinpoint them out. You break above the cloud, you break above that ATR band, you're good. Okay. I can sit here and I can give you a multitude of different examples, and that's exactly what I'm going to do with the last trading session. I'm not nitpicking. I'm really not nitpicking. It's just so you know. Really good example. First candle got blown out right here, and then right here had a decent signal for a long, but after, this was the candle that ultimately pushed you up. You had some of that footprinting in. Could you have taken this trade roughly about here? Honestly, I think I would. I think I would have taken the trade on maybe this column. Would have taken it on that column, looked to hold the position. If we were breaking below structure, maybe down here, maybe a little bit higher, then I would have taken off the trade. Same thing here with the shorts. We're looking at short. Normally, you don't see me in the Discord. I know this for a fact. You don't see me taking a short if that signal is not coming in and it's not breaking below the ATR band. It's just that simple. Cool? Okay. That's it for this part of the segment. You guys got enough examples. In the next segment, I'm going to be talking about settings, what you need to mess with, what you don't need to mess with, and we'll just talk a little bit about the makeup of the actual indicator, and then we'll go from there. All right, now let's talk about settings. Settings are important. You don't need to necessarily mess with the settings if you're trading the 4 indexes on futures, but you do want to mess with the settings if you're trading BTC or ETH. You don't really need to mess with it so much on CL or GC or anything like that. I said this in the beginning part of the video. I'm a futures trader, so if you're not a futures person, I would highly recommend that you look into futures. I'm not saying that because I want to influence you, so to speak, but I kind of do, because futures are a very happy medium between you not taking options that are going to decay very rapidly, especially if you're doing 0DT or 1DT stuff. I'm not a fan of that. I never have been a fan. I've been saying that for, oh my goodness, for years and years. I'm not really a fan of that. And day trading with shares is not that fun either. Futures are going to be the happy medium. You don't need all that buying power, right? You don't need $25,000. And it's relatively, I would say, relatively stable on the emotions. Okay, so let's jump into settings here. This is just NQ again. When you jump into the settings, there's a lot going on. If you're running into runtime errors, you just want to toggle off the heat map. So the heat map, right, is just a visual feature. You really don't have to have it on. It's honestly, it's more of a garnish than anything else. What you do want to have on is going to be the volume delta analysis, the volatility signatures, the relative volume spikes. This is really, really important because you want to know when the spikes are coming in. And the divergence detection, if you toggle it on and off, it's not really going to do anything, at least not visually. That's what I mean. It will give you some divergence detection. It's just going to be background calculations. Is it going to be a little bit more responsive on the columns, so to speak? I haven't found any significant data to support that or not. So if you want to just leave it off so it's a little bit easier on the back end math that's going on, that's okay. Intermarket volatility divergence, want to leave that on. The cumulative delta, this is the proxy, okay? You can get cumulative volume delta depending on what subscription that you have on TradingView. This is going to be good enough. If you don't know what the CVD is, I would recommend after watching this video, spend about an hour learning what a CVD indicator is. By itself, it looks kind of crazy, but the calculations from it they're built in everything that, aside from maybe an orb indicator that I put together that doesn't use CVD information, but anything that's calculating the difference between imbalances and structurally contract information is going to use a CVD indicator. You have to have it. Next is going to be the direct volatility of volatility. So I don't remember if I said this, but let me just include this here in this video. There are several layers of volatility calculations. Volatility on top of vol on vol is something that I don't necessarily see 100% clear benefit of you knowing. It's something that it's sort of an ambiguous topic, but it is important for when volatility of volatility starts expanding or starts showing signs. Usually that's going to indicate that volatility is ready to spike, okay? I mean, there's a lot to be said there. This is probably beyond the scope of this video, but just leave it toggled on. All right, just leave that on. The enable volume normalization, that you definitely want to have on. The normalization is going to be for aftermarket when there's some rumble and not really a lot of activity happening. You want to leave that toggled on because the volume that happens pre-market, post-market is not the same as what's happening during actual market sessions. Now, you just want to leave that setting as is. The enable statistical significance flow, this is important. This is going to look at overall percentages of how much volume is happening per a look back feature. I don't remember exactly what the look back candle structure is, but I imagine, if I remember this correctly, because I built this a couple months ago, I imagine it's the last 20 candles. So it's looking at this significance of volume. If there is a spike relative to the last 20 candles or just 20 pieces of data, and if it's significant enough, it's going to pick that up. This is how this indicator works quite well. It's taking the relative volume for a specific time period and it's updating that real time so it knows when to catch those spikes. And it's really responsive, okay? It's really, really responsive. A little bit lower than that is going to be the enable advanced ATR. This you can toggle on and off to see if it is going to make a difference for you. It should make a pretty decent difference. You don't want to mess with this if you are trading your indexes. If you want to go in for crypto, I'm just going to recommend you go 0.8 to maybe 0.7 and not more than that. You want a responsive indicator. You don't want it to be too responsive because then your signal to noise ratio is going to get muddied up. You don't want too many signals. You want a happy medium, right? You want You want pretty much split down the line, a good quality signal, but I also want to know what's kind of going on in the interminglings of things. Next, a little bit lower, enable hybrid VWRSI plus ATR. You do not need to mess with this. If you are a little bit more, I would say hypercritical on where your calculations are being derived from. If you are a more volume-based trader as opposed to an ATR-based trader, then you can mess with this. I haven't necessarily seen the overall, I haven't seen a huge difference between what setting that I'm looking for. The auto setting will look at a healthy balance between the two, and then it'll base the calculations off that. So really the auto and the balance feature are exactly the same. They really, really are. For source, this one is important, and this is worth going over. If you want to go for candle open, there will be a difference. Is it going to be a very large difference? I think that yes. I think that it will be based off of my back testing and based off of me using the indicator for a couple months. I've noticed that the close of the candle is generally where I have a little bit of a smoothing effect, just a tiny bit. That is something that I want. If you want to mess with this and see if your pulse indicator is lining up with the price action on the market that you're trading, that's perfectly fine. That's exactly why I included it in there, because I know that a tool needs to be fine-tuned for whatever market that a particular trader is trading. Now, lower than that, show technical levels, show divergence signals. The signals I don't necessarily use. You can customize this to however you like. I included that in the features here. But overall, the inputs and what we have showcasing, it should be pretty much out of the box. You should be okay. The heat map, if you have a strong enough computer, a computer that can do computations and compute, has a fairly decent amount of compute power, you can leave the heat map on. But all in all, I've broken down what I feel would probably be about 90% of all the information that you need in order to use the pulse indicator pretty accurately. If you want to jump into the Discord and just share your settings and maybe just share, hey, Sage, this kind of looks like this is rolling off a little bit here. Noise filtration here is not working as well as it probably could. Or here are some of the filtering settings that work a little bit better for the markets that I'm trading, so on and so forth. Feel free to do so. Honestly, that's perfectly fine with me, okay? So I'm going to give you some concluding statements here. And if you guys want to jump into the Discord or ask me any additional questions, please feel free. All of that will be in the descriptions. Okay, so what did we learn in this long ass video? Because I have a tendency of making long videos. We learned that we have to build context on all the stuff that we're using and putting on the chart. We have to know how to read the actual thing, what it's conveying to us. We also need to know a little bit of how it's built. You need to line up the responsiveness on where those changes and dynamic turns are happening. And it needs to be clear. It needs to be clear enough that we can identify a long and a short signal. Are you going to get it right all the time? I built the thing and I don't get it right all the time, but we need to at least know where some of the pitfalls are. So when you put on a new indicator, even if you buy one, or it doesn't necessarily have to be mine, but this is an important nugget. When you put something on your chart, it's not that you're going to know the thing off the bat. I usually think about musicians when I'm teaching these concepts. When you buy a new instrument, you don't naturally hug the instrument and it becomes part of you. You need to know the ins and outs and the intricacies of how the thing works. So you have that touchy-feely, bassy thing. A lot of traders are touchy-feely. I'm a little bit touchy-feely, but I'm a little bit more on the mathematical side. So put the indicator on your chart and see exactly where it's lining up. If it's hitting one of your systems and your system is telling you an EMA is giving you a short or a Bollinger Band is giving you a long, whatever, see exactly which one lines up better with the turns that are happening. So this way you have an A to B test. Not a lot of traders are telling you to do that, but I am. I'm telling you that for you to be responsive and for you to migrate out of a trading system that will work better for you or not work better for you, I genuinely want you to be successful. I want you to look at something and say, okay, this makes sense for me, and this is having a fair degree of success and accuracy on a turn, on maybe just a long or short signal, and that's really what it is about. So just remember, it's not necessarily about the tool, but how you manage the overall position when you take it. It's okay to take losses. I take losses literally all the time, but my winners overall compensate for all those losses that I take on a very consistent basis. So my win rate is not 80%, not even close. My win rate is between 47 to sometimes on a good month is like 62%. But overall, my losses are relatively small. And yeah, I take 3-4 losses in a row, but those winners that I take, they compensate quite well, okay? Those are my concluding statements. With everything that I will put out there, if you decide that you want to see me use these things in action, whether I'm going on power hour session or if I go on in a morning session, you can ask as many questions as you like. I want you guys to be successful traders. I want you guys to think a little bit differently than the masses, because I definitely don't think like everyone else. And overall, just be a better, more finely tuned, and just more prepared trader and investor for the long term. Any questions, any comments that you want to hit up, whether they're positive or negative, doesn't matter. That's totally fine with me. Jump into the Discord, leave them here on YouTube, and I will try to get back to you as soon as I possibly can. Look out for the additional videos that I will create with other indicators that I built, and then also look for those system-based videos where I show you how to line up certain indicators so you get the full picture on the trading strategy that I'm particularly using. Thank you for watching this video, and I'll see you guys in the next one.